Good afternoon, ladies and gentlemen. Welcome back to this week, 19th of August, weekly market review. As usual, on this Monday, I have my co-host with me, Mr. Gerald Wong. How are you, Gerald?
Hi, good morning. I'm very well. So last week we had a good rebound in the market after the volatility in the week before. We also had some of the Singapore companies reporting their earnings. We had the National Day rally just last night. So quite a number of things that we have in the market, and we'll be happy to share some of these developments with everyone in today's weekly market review.
Yes, indeed. Market did make a very intense comeback, I would say. And because of some of the positive economic data that came out last week in the US, the recession fears that market is looking at the previous week seems to be overblown, and market seems to be on a risk-on mode again right now. So I think, Gerald, you'll go through some of the latest happenings with us today, right?
Yes, that's right. As usual, we will have some disclaimers that today's sharing is for information purposes only and should not be taken to be financial advice. Okay, we have an upcoming Ask SIAS. This is free and exclusive for members of SIAS on Wednesday, 21st August. So if you have any questions that you'd like to ask Sunny and myself, do register for the upcoming Ask SIAS session through this QR code, and we'll be awaiting your questions at the session. Okay, if you find the weekly market review helpful, do leave us a review on Google. And if you would like to join SIAS as a member, you can go to this website or scan this QR code where you'll be able to join many more investor education programs as well as access various resources. Okay, so what did we see for the market last week? There was a strong rebound. The S&P 500 had the best week of the year, up by 3.9% to 5,554, while the Nasdaq, which is a tech-heavy index, saw an even stronger rebound by 5.3% to 7,632 points. Okay. Closer to home, the STI also did well, now back to above the 3,300 levels again, following the 2.8% gain last week. Okay, so what drove the rebound in the market? Okay, so first and foremost, we saw the consumer price index data that came out. This was actually in line with market expectations, but we see here that the year-on-year increase in the consumer price index is actually at the lowest level in quite a while, at 2.9%. So this actually led investors to gain confidence that we will be getting a potential rate cut in September. Okay, apart from that, we also saw economic data that displayed the strength in the US economy. We have the US retail sales data. The US retail sales grew by 1% in July compared to the previous month. And once again, you see that this is actually the strongest level in the past 12 months. And once again, indicating to investors that the concerns of a recession in the US might be overblown, okay? Because the retail sales is actually still at a very resilient level. Okay, so with a combination with the expectation of the rate cut together with the strong economic data, we have seen the strong rebound in the market. This is the expectation of the rate cuts in the remaining months of the year. What we see here is that for the upcoming meeting in September, investors are now putting in a 75% probability that the interest rate will be cut by 0.25% or 25 basis points. But at the same time, there is also a 25% probability that we'll see a sharper rate cut of 50 basis points or 0.5%. Okay. And if we look at the upcoming months of the year, potentially another rate cut in November, another one in December, such that by the end of this year, we might see interest rates about 1% lower compared to where it is currently. Okay, so this is the current expectations around the interest rates based on the CME Fed Watch tool. In the Singapore market, we saw earlier that the STI also did well. Quite a number of stocks that were up by more than 5%. including ST Engineering that reported their results up by 8.1%, DBS up by 5.9% after the strong results that we saw being reported in the previous week. So if you missed the update, you can check out our previous week's weekly market review. Okay, in terms of worst performers, we have Thai Bev down by 3% due to some of the political developments in Thailand. UL and CityDev, the developers also saw the share prices coming down due to some of the weak transaction data that has come out in Singapore's property market. Okay, so a few names that I would like to go through today based on what we see a lot of investors asking us about. The first one is CICT, one of the more resilient Singapore REITs, where we see that since November last year, the share price has rebounded from a low of about 170 per share to now $2.11 per share. So definitely one of the better performing REITs so far this year. Okay, in terms of what CICT reported, what we see is that in the first half of 2024, there was growth in its gross revenue, net property income, distributable income, as well as the distribution per unit. Okay, so if you have been following us for the various weekly market review, you have noticed that most of the REITs actually reported a decline in their DPU. Okay, CapitaLand Integrated Commercial Trust is one of the very few REITs that managed to report an increase in the distribution per unit in the first half of this year. So a combination of their ability to grow their net property income, not such a significant increase in their financing cost, which actually enabled them to grow their distributable income. Okay, so just as a recap, one of the strengths of CICT is really in terms of its broad-based exposure to various assets. So what we see here is that Singapore would form the bulk of the assets. So as a result, it hasn't been as impacted as some of the other REITs by the currency movements. Okay, if we break this down, CBD office would be about 29% of their gross revenue, suburban retail at about 28% of their gross revenue, downtown retail at 25.6%, and then you have the remaining that is from hotels, convention centers, office, and some overseas assets in Australia and Germany. Okay, so it is really this diversified portfolio, most of which are Singapore-based assets, that's enabled CICT to do well. Okay, if I were to look across their portfolio, the gross revenue I mentioned earlier was up compared to the previous year in the second quarter. The net property income was higher as well. Okay, and we see this increase in the gross revenue and NPI across their retail assets, the office assets, as well as their integrated development. Okay, so across the board, we saw that they have been able to grow their gross revenue as well as net property income. Okay, if we were to look at the occupancy rate, retail saw an improvement in the occupancy rate to now 99%. So very strong retail occupancy rate numbers. And then for integrated development, fairly resilient as well at 98.8%. Office occupancy came down slightly from 95.8% to 95.3%. And then as a result, for the entire portfolio, we saw a slight dip in the occupancy rate of CICT to now 96.8% from 97% in the previous quarter. But overall, still fairly high occupancy rate across the entire portfolio of assets. Okay, we also see that they've been able to raise their rents as well. If you look at the rent reversion for year to date for June 2024, then for the retail portfolio across both suburban malls as well as downtown malls, they have been able to get higher incoming rents versus the average outgoing rents. Okay, if I were to look at some of the underlying stats of the property in retail, what we see here is that the tenant sales was about flat year on year. The suburban malls have been doing better, which managed to grow their tenant sales by 1.8%. But for downtown malls, we actually see a decline in terms of their tenant sales. Okay, so this is partly a reflection of the slowdown in tourist arrival growth, which is probably impacting the downtown malls more than the suburban malls. Okay. Okay, if I were to look at the office assets, what we see here is that in Singapore, actually, the occupancy rate has been holding up fairly well at 97.3%. But where we see a stronger decline in the occupancy would be in Germany as well as in Australia. Okay, so as a result, the overall portfolio occupancy for office came down to 95.3% from 95.8% in the previous quarter. For the Singapore office assets, we continue to see that the average rents has continued to grow from $10.63 per square foot in the quarter ending March to $10.66 for the quarter ending 30th June. Okay, so overall, the Singapore office portfolio is still fairly resilient, and that has helped to offset some of the weakness that we see in Germany as well as Australia. Okay, so what I wanted to go through would also be the balance sheet of CICT. The average leverage has come down slightly to 39.8%. Okay, and if you look at the interest coverage ratio, fairly strong interest coverage at 3 times. And in terms of the average cost of debt, it has stabilized at about 3.5%. So with the growth in its occupancy rate as well as the higher rents, it has been able to grow the distribution per unit to unit holders. Okay, if I were to look at the valuation of CICT now, price to book of about 1 times. Okay, so that's now above the historical average. And if I look at the dividend yield, about 5.2%, which is below the historical average dividend yield of CICT. Okay, next stock I wanted to talk about is CapitaLand Investment. One of the names that have been fairly weak in terms of the share price so far this year. Okay, we have seen this decline from about $3.20 per share to actually reaching about $2.57 as of the market close last Friday. Okay, so what we saw CapitaLand Investment reporting in the earnings would be a softer operating profit after tax and minority interest. It was down 14% compared to the previous year. And if you were to look at the breakdown here, okay, what we see for the fee income related business has been fairly resilient, but the real estate investment business actually saw quite a significant decline in the operating profit after tax and minority interest to 104 million in the first half of this year from 175 million in the first half of the previous year. Okay, so with that, we have seen that the overall cash PATMI or profit after tax and minority interest of CapitaLand Investment actually declined in the first half of this year, even though they've been able to book higher portfolio gains. Okay, we look first at the fee income related business. This is the business that has been more resilient. And what we see here is that across most of the different businesses, whether it's a private fund management, lodging management, and commercial management, the fee income actually grew. The listed funds management revenue came down slightly, but overall, we still managed to see the fee income related business revenue growing about 8% compared to the previous year. Okay, so this is the more resilient part of the earnings, where because of the fund management fees that are more recurring in nature, they've been able to grow this part of the business, even with some of the macro headwinds. Okay, but where we see actually some of the weakness is really in this real estate investment business, where we see that the operating profit actually came down. If we break it down by the geography, where it's been slightly weaker is really in non-Asia, okay, where actually the operating EBITDA came down to 135 million compared to 548 million in the previous year, okay. So, where we see this weakness, once again, if I were to break it down across listed funds, private funds, and balance sheet investments, then most of this would come through from the balance sheet investment of CapitaLand Investments in non-Asia, where we have seen this decline in the operating profit. Okay, if I were to look at some of the other geographies that have been weak as well, Southeast Asia also saw a bit of this decline. So there are some of these geographies where we see weakness in CapitaLand Investments operating profit. Okay, if we were to look at CapitaLand Investments valuation now at about 0.96 times price to book. So this is now below the historical average valuation of CapitaLand Investment. Okay, last but not least, ST Engineering, a stock that's done very well so far this year. In fact, one of the better performing stocks in the STI, where we saw that it reached a 52-week high recently after announcing their first half results. Okay, so what we see for ST Engineering results is strong growth in the revenue and profit in the first half of the year. Revenue was up 14% compared to the previous year, and net profit was up 20% compared to the previous year. Okay, the good thing about the earnings is that they have been able to grow the operating profit across all three business segments, across commercial aerospace, defense and public security, as well as urban solutions, as well as Satcom. Okay, for commercial aerospace, that's really driven by the improvement in maintenance, repair, and overhaul business, as there are more flights that are flying, as well as some of the aircraft that then require the maintenance work. We have seen an uplift in this commercial aerospace business. Okay, defense and public security, because of the growth in its order book, as it positions itself for defense business, this has seen a growth in its profit. And then for urban solutions and Satcom, we have seen this growth coming through very strongly as well. Okay, I mentioned earlier that ST Engineering has been able to secure quite a number of contracts. So in the first half of this year, 6.1 billion worth of contracts won, quite evenly distributed across all three businesses, where we see that in defense and public security in particular, it won 2.6 billion worth of new orders in the first half of this year. Okay, with that, the order book has grown to 27.9 billion, of which it expects 4.9 billion to be delivered for the rest of this year, and will help to support the revenue of ST Engineering in the second half of this year. Okay, if we were to look at the valuation of ST Engineering, I mentioned earlier that the share price has done very well year to date. So now price to book of 5.5 times, which is above the historical average of 4.7 times, and dividend yield of about 3.5%, which is below the historical average dividend yield of 4.2%. Okay, in terms of what to look out for this week, we have a SIAS Corporate Connect with Cromwell European REIT on 20th August on Tuesday. Okay, I mentioned earlier that we have a Ask SIAS on Wednesday, 21st of August. So those are various events that you can take part in to be able to understand more about these businesses and to deepen your understanding around investment. Okay, so with that, I'll hand over to Sunny, who will share the technical analysis of the markets with us.
Hey, let me share my screen first. Okay, thanks Gerald for that insightful sharing on some of the business updates and earnings results from the Singapore market. So I think the STI index opened relatively flat this morning on 19 August morning. We are about close to an hour into the trading session already. So you can see that STI is having a rather slightly negative day or a flat day, but there are some key turning points to look at in the STI. So first thing, after the rally of last week, right, you can see that the prices is now testing the previous high that we observed in the early part of the June period, and that is around the 3,350 points level. So if we can cross above this level in the next few trading session by the end of the week, this could become a new support level for the STI to continue to rebound higher and retest the high on the middle of July, which is the year-to-date high at the 3,509 points. So why do I say that this could be a turning point? So besides it testing the previous high in June, if we can cross over, that will be a resistance turn support level. It has also starts to cross above the 50 days and the 200 days exponential moving average, and that is a positive sign because if prices are above those moving averages, it means that the prices do have a positive momentum right now. And if I'm going to zoom closer into the moving averages, you can also see that the 20 days moving average also starts to turn upwards already. And if it's crossed above the 50 days moving average, which is the blue line, that could mean that a short-term uptrend is likely to be confirmed if a crossover happens from there. Oh, the other indicators on the MACD is also starting to converge towards the signal line, and we are on the verge of having a crossover of the MACD line above the signal line now. So that means that if a crossover happens, that could signal a start of another uptrend that we are looking at on the STI index. And if the crossover happens and the MACD line cross above the zero baseline, then that means that the momentum would be increasing further, and thereby retesting the year-to-date high at 3,500 would be a likely possible scenario that's going to happen according to the MACD indicator. On the RSI, the latest reading on this Monday is that the 50-point neutral mark. So last week or the week before, last Monday, I think we breached the 30-point oversold level on the STI, and we do have quite a significant rebound. We have now come back up to the 50 points level and also above the 41-point reading on the 14 days moving average on the RSI. So what the indicators are telling us that the momentum on the STI is increasing right now, the uptrend momentum, and likely this uptrend is going to continue with this positive momentum reading. And the next support level that we are looking at would be if you're going to cross over the 3,350 level, that could become the new support level for the STI to push higher another 150 points to reach the year-to-date high at 3,500 points. Okay, next, let me move to the US indices. So just a recap of the US earnings season. I last checked on Bloomberg, about 98% of the US S&P 500 companies have already published or released their earnings results. So of that 98% that reported, 78% was above market or analyst expectation. So that means earnings is still coming in strong. Okay, on the Dow Jones Index, you can also see that there is also a bounce since the low that we observed on the 5th of August, the big drawdown caused by the Japanese yen carry trade and some of the bad US economic data on the jobs, on the US jobs data. So we have rebounded quite a bit. We have retraced, I think, almost 70% of the drop since the 15th of June period. And now Dow Jones is at the 40,659 points level, well above the 20 and 50 days moving average. That means that it is on a very strong ground to retest the year-to-date high or the all-time high again at the 41,376 point level. The MACD indicator, as you can see, the crossover actually happened last Friday, and then we saw the first green shoot on the MACD histogram bar. That means that the confirmation is already in that the Dow Jones Index is likely going to be on an uptrend again. On the RSI, we also had a very healthy reading close to the 60-point mark as of last Friday, and that shows that there's pretty healthy momentum, uptrend momentum in the Dow Jones Index right now, and both indicators are agreeing that the uptrend is likely to continue. Quick look at the US futures before the US market opened today. You can see that the US futures is also in the green right now. So likely when US market opens tonight, it will likely be able to hold on to the gains that we saw last week and build on those gains towards the year-to-date high or the all-time high at 41,376 points. Next, let's us move to the broader index S&P 500. For S&P 500, you can see the rebound also happened. We nearly tested the 200 days moving average, but that did not happen. So if you're able to capture this rebound over here, that will be, you are also be in a good position right now. So we are still about 2%. The last Friday closing index point at 5,554 points. It's about 2% away from the all-time high that we are seeing at 5,669 points. So that is a very close range that we are looking at right now, and market being in a risk-on mode again, I think there's a very high chance and very high probability that we will retest the all-time high at 5,669 points. Looking at the indicators, you can see that the crossover happened in the midweek of last week, and we already have 3 sessions of positive MACD reading. That means that the momentum in the S&P 500 index now is positive, and with the divergence of the MACD above the signal line, that shows that the uptrend momentum is actually growing as well. And once a crossover above the baseline happen, that will provide some exponential momentum growth again for the S&P 500 index, and that would likely definitely test the year-to-date high and the all-time high again. On the RSI, we have a 59-point reading close to the 60-point mark. That also means that it is in a very healthy range, a very healthy reading with very healthy momentum right now. So that means that the uptrend is likely going to continue, and that coincides with the MACD. So I think markets in a risk-on mode right now. You should be looking at taking a long position on the S&P 500 index from now going forward to the year-to-date high again, and we'll update you guys once it reaches that level, and we'll reread again whether there is any kind of a overbought signal from the indicators. Okay, lastly, let's move to the tech-heavy Nasdaq Composite Index. Just to take note here, there will be some tech companies announcing their result this week as well. So there are Zoom and Workday, which will be reporting this week. Although I do not think that they will move the needle, most of you guys will be looking at the NVIDIA results, which will be coming out towards the later part of August, the final week of the August month. That would likely more move the Nasdaq Composite Index as the tech-heavy index, okay? So the Nasdaq Composite Index finished at 17,631 points last Friday. So we are close to about 3% away from the all-time high at 18,671 points. Looking at the indicators, similar to the S&P 500, we have 3 sessions of a positive MACD reading already. So that means that the momentum and the trajectory of the Nasdaq Composite Index is in an upward trend, and the momentum is going very strong. On the RSI, the reading at 56 is also in a healthy range above the 50-point neutral mark, and not in quite a distance away from the 70-point overbought level. So that means that there's still a lot of room for the Nasdaq Composite to move higher, and that could mean that the retesting of the all-time high at 18,671 points is a high probability kind of a scenario, and that market is in risk-on mode right now. So a lot of investors are looking at taking a long position on the Nasdaq Composite Index as well. So these are the key observations that I see from the major US indices last week. And hopefully this week, the rally is likely going to continue, and we could see another positive week when we update you in the next weekly market review. So Gerald, anything else that we need to watch out for going forward this week?
So I think in the Singapore market, it is relatively quiet. We are done with the earnings season. We do not have major macro earnings reporting this week. So I think we can take some time to consolidate what has come out over the past few weeks, given that it has been fairly volatile since the start of August.
Yes, so it's good to have some breathing space to reanalyze the market. And I think most of the fears that we have seen over the past few weeks has already subsided a lot, and it's looking for a positive going towards the end of the year with the rate cuts coming. That could be another catalyst. So these are the updates that we have for you this week, and we look forward to you joining us again next Monday on the next weekly market review. So everyone, have a good trading week ahead, and we'll see you on next Monday. Goodbye.